Welcome back. Let's continue with part 2 of the lecture, Interest Rates. Let's look at our second theory regarding rates, the liquidity preference theory. This theory states that people like to have liquidity in their assets. Liquid assets are less risky than illiquid assets. You don't have to sell to create cash. If you have cash, it already is cash. If you're looking at a more liquid asset, say inventory or accounts receivable, compared to buildings or land or machinery, then the greater liquidity decreases the risk. It's easier to convert by selling those assets into cash. If interest rates increase, then there's a loss in asset value. In the lecture on bonds, we talk about the inverse relationship between interest rates and bond prices. When interest rates move up, then the fixed interest rate on a bond becomes relatively less attractive, and that results in a price decrease for that asset. So in a more general sense, we can apply that concept to investments and state that when interest rates increase, or there's an anticipation of interest rate increases, that tends to drive down asset values. So if you're invested in bonds, in some cases stocks, other types of assets, there's the risk that your investment value will go down. And so the response on the part of the market, on the part of investors to interest rate expectations is if interest rates are expected to increase, that drives the market to sell assets. If interest rates are expected to decrease, then that drives the market to buy assets. And the second point, if market rates right now are 6%, and I can buy a bond that's yielding 6% based on a fixed coupon of 6%, a year later, if interest rates have dropped to, say, 5%, I have a bond that still pays a fixed coupon of 6%, and the value of that bond will go up because of the relatively attractive 6% interest rate that bond pays relative to other rates in the market, and the value of my asset will increase. Under this theory, real rates can change quickly because this theory emphasizes the role of monetary authorities in driving rates. So there is the concept that one of the factors that influences interest rate expectations is what the central bank plans on doing regarding interest rates. And if they plan on adjusting rates, then the market will respond by selling assets. And if there's an anticipation that the central bank plans on decreasing rates, then the market response would be to purchase assets. So there's a close relationship between the anticipated activity at the central bank and how investors respond in the market, and the result is a change in rates. And in this theory, the central bank, the monetary authorities have a close connection, have a strong influence in the movement of interest rates. Now, looking at another perspective of the monetary authorities and interest rates, when the central bank adjusts rates, they're trying to influence the market rate. If they want rates to go up, then they make their rates higher. If they want rates to go down, they will make their rates lower. However, that doesn't mean that all banks will respond based on that interest rate movement. Large banks have market power, and sometimes they do their own thing. They don't follow the movement of the central bank. So let's look at a couple questions to consider to understand this concept: banks, interest rates, and strategy. Question 1, do banks lower their rates when loan demand shifts downward? In other words, when fewer people want to borrow money, do banks say, well, demand is lower, so let's decrease our rates, and that will attract more customers? Or do they just say, our rate is our rate, we're not going to adjust it, and we'll simply lend less money? The reason they might make that second choice is because if they're going to lower the rates on their loans, then they're also going to need to lower the rates they pay on deposits. Otherwise, they won't continue to be profitable. And if a bank lowers the rates that they pay on deposits, fewer people will want to deposit money in that bank, and the bank won't have the same reputation as it had at the higher rates on offer for deposits. So a bank might just decide to not follow the central bank movement, in order to maintain the spread between their loan rates that they are receiving and the deposit rates they are paying without changing those rates. Second question, do banks lend to everybody at the market rate, or do they only lend to the best borrowers? Well, when we say the market rate, there are really multiple market rates, and those rates are based on, among other things, risk. So a bank, say, sets a mortgage rate for home loans of 5.5%. That doesn't mean that just anybody can borrow to buy a home at 5.5%. The bank's going to look at the risk profile of that individual or that entity and make a decision, yes or no, you can borrow at this rate. And a couple other options would be, if you don't qualify for this particular rate, in this case 5.5% based on your risk profile, then we'll allow you to borrow at a higher rate. Or the other possibility is, we simply don't want to lend to you at all. No matter how high the interest rate might be, we don't see you as a good risk, so we're not interested in making a loan to you. And finally, let's look at the concept of the term structure of interest rates. The term structure of interest rates relates to the relationship between what interest rates are for short-term, intermediate term, and long-term investments. An important concept regarding the term structure is the yield curve, and the yield curve is how we visualize the relationship between interest rates and the term of the investment, the time to maturity. And factors that drive the shape of the yield curve are future anticipated interest rates. Are interest rates anticipated to move up or down? Second is the preference for liquidity. In general, it is safer to have money invested for a shorter period of time, and therefore an investor will require a relatively lower rate of interest for a shorter term investment than they will for a longer term investment. And the final factor is the likelihood of inflation in the future. So when we look at the yield curve, we're either going to see a flat curve, which means that short-term investments have the same rates as long-term investments, or we'll see an upward moving curve, which is probably the most common shape of the yield curve, which indicates that short-term investments have lower rates than long-term investments. There is also the possibility of a downward sloping yield curve, which would indicate at that particular time in that particular market that short-term rates are actually higher than long-term rates. So the shape of the yield curve is driven by several factors, and that shape isn't static. It will change over time depending on the influence of these various factors in a market. This concludes the lecture on interest rates. Be sure to work through the exercises associated with this content, and I look forward to seeing you in class for our case study analysis.